In Chapter 4, we're going to look very closely at the income statement. And getting started with that, I'd like us to kind of look at the diagram that I have in front of you. We have two companies, Belford and Corinth, and I'm showing a diagram of their quarterly earnings, so a very visual sort of thing. So if you were looking at these companies, what would you project the fourth quarter earnings to be based on the diagrams? So if we look at the first company, we can see there's been steady growth. We would somewhat anticipate, that in the fourth quarter, that would continue, right? Over here at Corinth, we started out the same place, but then we had a higher second quarter and then not so good third quarter. So, who knows? That's the big question mark. Who knows whether that fourth quarter is going to go up or whether it's going to go down. Well, this may be real. This may be what really happened to each of these companies, but it's also possible that Belford indulged in a little bit of what we'll call income smoothing or earnings smoothing, meaning that they may have actually had the income over here that Corinth had for the second quarter and third quarter, but what they did is, they took some off, and they took some out of their second quarter and moved it over to the third quarter so that it would look like there'd been steady growth. So they, in essence, shrunk the second quarter and moved some of those earnings over to the third in order to have the appearance of steady growth. That's income smoothing. Again, that's where you're kind of moving revenues or expenses from one period to another in order to have the appearance of steady growth, to have a smooth earnings. And that totally violates the periodicity assumption, assuming that we have the same accounting periods, that revenue and expenses are to be recorded in the accounting period in which they occur. So it violates that principle. The other concept I want to talk about real briefly, and it's in your textbook, is this idea of cookie jar reserves or a big bath. Cookie jar reserves or a big bath is when maybe a company has a bad year and they will overindulge in that bad year. In other words, they'll make expenses and liabilities look worse than they even are. So they exaggerate the expenses because they know, profits are down anyhow, so let's just make it look really down. And by doing that, they can do that through estimates, because we use a lot of estimates in accounting. So like estimated bad debt expense or estimated depreciation expense, they'll overestimate in this year of the big bath, and so then in the future years, they have smaller depreciation expense, smaller bad debt expense, so the future years look better than they actually should. So that's a cookie jar reserve. The other thing I'd like to talk about is, I'm actually going to pull from your textbook. So if you will turn to your textbook, this is page 160 is what I have on the screen. I just want to briefly kind of highlight, it's already in the book and you can read it, but I do want to highlight and make sure that you're concentrating on certain things. One is the value of the income statement. And we would have seen this in chapter 1 and 2. The income statement helps us determine the amount, the timing, and the uncertainty of future cash flows. That's the whole purpose of the financial statements anyhow, being able to project those. And we talked about that in chapter 2. Your authors talk about the good, how useful the financial statement is. We can look at how the company's performed in the past. Past performance helps analysts predict future performance. And also it helps us assess risk. And it gets back into here, the amounts, timing, and uncertainty of those. Uncertainty is risk of future cash flows. So number 3 is kind of getting into that all over again. And the one thing I might really want to point out here is this idea of non-recurring sources of income. So we're going to see on the income statement, we're going to break out things that tend to occur over and over again, typical operating activity, from activity that doesn't occur very often. It's non-recurring. And we'll see the value of that on the income statement. The other thing I like about the textbook is it talks about the downside, the limitations of the income statement. Sometimes companies omit things from the income statement. Typical one omitted actually is the value of employees. They often don't get recognized. This also lists some other things, increasing the value of a brand. We don't recognize that because it hasn't actually occurred, or we haven't realized it. So if it hasn't been realized in accounting, we don't recognize it. And then these unrealized gains and losses on some investments. Oftentimes we don't recognize a gain or loss until we've actually sold the investment. Okay, and then number 2, the income numbers are affected by the accounting methods employed. So, if we use a straight line depreciation method, that's going to give us a lot different income number than if we use an accelerated method. So, and I like your book using saying, well, that's like comparing apples with oranges, very different things. And the last one too, there's a lot of judgment involved, especially with estimates. Like for depreciation, we estimate the life, we estimate the salvage value of the asset. All of that's going to affect earnings as well. Okay, let's see. I also want to talk about on page 163. On 163, this is kind of, didn't print out very well, did it? But these are the elements of the financial statements. This is supposed to say the word revenue. But I want, there's a lot of narrative here, but I do want to point out you really need to know these elements by now. We've covered those, we're in chapter 2. Now we're very much seeing a very clear-cut application of these in chapter 4. So revenue, and revenue is an action, right? It's from delivering goods and services. So we deliver goods and services, and what's going to happen? Well, that's either going to cause assets to go up or liabilities to go down. So it's inflows of assets or the settlements of liabilities. So assets go up, liabilities go down, and it's from delivering goods and services for the most part. The next one's an expense. Well, expenses, again, are from using goods and services. So again, we're using something here. If we use something, we may be using an asset, it'll go down, or we owe money for whatever the service is. So again, it's using up of assets or incurring liabilities from, delivering goods and services. So again, expenses, we have an expenses because we used something or consumed a cost. We consumed a cost, that's an asset. And then gains and losses. Gains and losses are peripheral. They're not core activity. They're peripheral type of activity. And those are going to cause our net assets to go up, if it's a gain. Or it'll cause our net assets, I'll just put in A here, net assets to go down. Remember, net assets are our assets minus liabilities. So we're netting the assets, taking the liabilities out of the assets to see what the net is. You may have also recognized that's the formula for stockholders' equity, right? Assets plus liabilities also gives us stockholders' equity. So stockholders' equity is the same amount as net assets, but really I'm thinking about things differently. Stockholders' equity, then I'm thinking of the owner's equity in the assets. Net assets is another way of thinking about that same number.